Welcome to the Workbook Solutions for Chapter 6, where we'll cover inventories. Please remember that if you have the workbook, the page number of each problem I go over may have changed. So please check a few pages to the left or right if there's a mismatch. Let's start on page 3 of the workbook with an exceptionally easy problem. At the beginning of the current year, Jim Mozart opened a music store that sells compact discs of classical music. The store is called Classically Trained. During the year, Classically Trained purchased 10,000 compact discs for $7 each. At the end of the year, a physical inventory count revealed that 1,000 of those discs were on hand. What value should be shown for ending inventory on the year-end balance sheet? People think of accounting as a math discipline, and it certainly is, but it's just as much about reading comprehension. In this case, your mind may have already jumped to the inventory equation I told you to memorize, but we don't even need that just yet. We already know how many discs we have as of the year end, 1,000. We also know the cost per disc, 7 apiece. Getting the dollar value of that inventory is a simple matter of multiplying the units by the cost per unit. In this case, 1,000 units times $7 per unit, or $7,000, which is our ending inventory value. What if Mr. Mozart purchased his inventory throughout the year at various price points? You can find this information on page 4 of your workbook. With this problem, we'll calculate ending inventory and cost of goods sold under the periodic method, meaning we're performing these computations at the very end of the year as opposed to each time a sale is made. On the first of the year, he bought 800 discs at $7 apiece. On March 8th, he bought 2,200 discs at $7.50 apiece. On June 23rd, he bought 4,000 discs at $7.25 apiece. And on September 15th, he bought 3,000 discs at $7.40 apiece. The totals at the bottom show that he purchased 10,000 units at a total cost of $73,300. If the year's ending inventory equates to 1,000 units, at how much will that inventory be valued on the balance sheet? Let's also decipher cost of goods sold. These valuations will vary depending on which flow assumption Jim uses. For starters, imagine he's using the FIFO method, first in, first out. To make these calculations, we'll need to determine how much inventory was sold from each layer, as well as how much remains. To start filling out that unit sold column, we can start playing with that formula. Beginning inventory plus purchases equals cost of goods sold plus ending inventory. We know how much inventory Jim acquired, and we know how much is left. So we want to solve this equation for cost of goods sold. Note that since we're expressing these terms as units, not dollars, for that reason, cost of goods sold is just the unit sold, not the cost of what was sold. If we subtract cost of goods sold off each side of the equation, the two terms on the right side will cancel each other out, and we'll have the following formula for cost of goods sold. This was Classically Trained's first year of operations, so beginning inventory was 0. Classically Trained bought 10,000 discs over that time period, and Classically Trained has 1,000 units left. Do the math, and you'll see that Classically Trained sold 9,000 discs. Under FIFO, this means that Jim sold 800 units from the January 1st purchase, 2,200 units from the March purchase, and all 4,000 units from the June purchase. These three sums up to 7,000 units sold. Total units sold throughout the year is 9,000. So to get to that number, we just need 2,000 units from the September purchase. If that's what we sold, what do we have left? Classically Trained has exhausted all inventory from January, March, and June. The 1,000 units remaining are all entirely from the September purchase. Since those remaining 1,000 units were bought at a price of $7.40, multiply them together to get a dollar value of $7,400. As for the cost of what we sold, we take the units sold from each layer and multiply them by their respective costs. Then sum those products together. If you work out the math for yourself, you should get $5,600 plus $16,500 plus $29,000 plus $14,800. In other words, $65,900. That's our cost of goods sold. You can arrive at this amount even more quickly by using our formula. Add the beginning inventory of 0 to the purchases of 73,300 and subtract the dollar value of 7,400 that we just determined. And once again, cost of goods sold turns out to be $65,900. What if instead of FIFO, Classically Trained uses LIFO? Jim still has 1,000 units left, and he sold 9,000 units. If the last inventory bought is considered to be the first inventory sold, this means Classically Trained sold all 3,000 units from September, add in the 4,000 units from June, and we're at 7,000 in sales. And we need just 2,000 units from March to get to 9,000 units. Classically Trained didn't sell anything from the January purchase. What's left under LIFO? Classically Trained sold all of September and June's inventories. Of the 2,200 bought in March, only 200 units remain. And of course, Classically Trained still has all 800 CDs from January. To tabulate ending inventory, multiply the 800 units from January by $7 per unit. Do the same for the 200 units from March by $7.50 per unit. And the total is $7,100. Of course, you can use the same method to determine cost of goods sold, but the formula is always the best option once you have 3 of the 4 variables. This simpler method leaves less opportunities for mistakes. Plug and chug, and cost of goods sold should be $66,200. Let's now examine the perpetual inventory method. If you'll turn to page 7 of the workbook, you'll see the following entries. Let's book these entries and determine the cost of inventory on hand using the specific identification method. Note that all inventory items are sold for $1 apiece, and this price will not change even if the inventory cost goes up. Starting with the entry on April 1st, the company buys 4 10-cent items on account. The journal entry will have a debit to merchandise inventory and a credit to accounts payable for 40 cents, the product of the 4 items purchased at their purchase prices. At this point, the cost of inventory on hand is also that product. On April 3rd, a customer purchased 2 of the 10-cent items for cash. Our journal entries to record sales of merchandise inventory consists of a debit to cash and a credit to sales for $2. The 2 units sold times their $1 retail level sales price. We also have to expense merchandise inventory off the books with a debit to cost of goods sold and a credit to merchandise inventory. Determining the cost of this sale is also simple and direct. 20 cents. Our inventory only has one purchase price associated with it, so that's what we multiply by the 2 units sold. What's the value of our remaining inventory? We had 4 units and we sold 2, so we only have 2 units left at 10 cents per unit, yielding total inventory cost of 20 cents. April 6th, we purchased 4 12-cent items on account, debit merchandise inventory, and credit accounts payable for 48 cents. The 4 units bought at 12 cents per unit. We now have a new layer or pool of inventory. Those 4 units purchased at a total cost of 48 cents, bringing the total value of inventory to 68 cents. On April 12th, a customer purchases 3 inventory items for cash. One was a 10-cent item, and the other 2 were 12-cent items. We'll recognize revenue with a debit to cash and a credit to sales for $3. We remove merchandise inventory off the books with a debit to CGS and a credit to merchandise inventory. As for the amount, here we see the specific ID method applied. Remember that this method is not a cost flow assumption. We're not assuming anything. Instead, we know exactly which items were sold as well as their respective costs. We sold 1 item at 10 cents and 2 at 12 cents, or 34 cents of merchandise inventory. How much merchandise inventory do we have left? Of the 10-cent items, we sold 1, so we have 1 left. Of the 4 12-cent items, we sold 2, so we have 2 left at a value of 24 cents. Sum those 2 products, and we have a total inventory value of 34 cents. On April 20th, we acquired 4 15-cent items on account, debit merchandise inventory and credit accounts payable for 60 cents. We'll add this new pool of inventory to what we already have. yielding a total inventory cost of 94 cents. On April 27th, a customer purchased 5 inventory items for cash. One was a 10-cent item, 2 were 12-cent items, and 2 were 15-cent items. Again, we'll record our revenue with a debit to cash and a credit to sales for $5. Next, we'll debit cost of goods sold and credit merchandise inventory for 64 cents. Multiply each unit sold by its respective cost. Then sum those products. What's the value of our remaining inventory? Of our 10-cent inventory pool, we sold the one item we have, so that item is gone. We also sold the entirety of our inventory at 12 cents apiece, so that layer is empty as well. Of the 4 15-cent items, we sold 2, so we have 2 left at 15 cents apiece, bringing our total inventory value to 30 cents. If you wanted to verify the accuracy of this amount, you could do so by drawing a T account for merchandise inventory and posting those journal entries. Do so, and the balance in the account will be a 30-cent debit, exactly the value we just calculated. Let's perform those exact same tasks for those very same entries, but this time using the FIFO cost flow assumption. See pages 8 and 9 of your workbook, beginning with our transaction on April 1st. Our first 2 entries will be booked in the same manner and with the same amounts as in the previous example. The April 1st purchase will consist of a debit to merchandise inventory and a credit to accounts payable for 40 cents, yielding a current inventory value of that amount. For the 2 10-cent items sold on April 3rd, recognize the revenue and remove the merchandise inventory. The value of merchandise inventory remaining is now 20 cents. Our first entry on April 6th will also be the same. Debit merchandise inventory and credit accounts payable for 48 cents, bringing total merchandise inventory to a value of 68 cents. On April 12th, the sale of 3 items for cash will have the same entry for the recognition of revenue. However, the entry to expense merchandise inventory will show the impact of the FIFO method. First in, first out means that we fill out our cost of sales by pulling from the oldest layer of inventory first and work forward towards more recent purchases. The oldest layer of 10-cent items only has 2 units in it, so those will be put in the entry's amount. To get to 3 units sold, we need to take 1 unit from the more recent layer of inventory at 12 cents. What's the inventory's remaining value? Like I said, we completely exhausted the first layer, so that one is at 0. Of the 4 units in the second layer, after removing 1, we have 3 left, making our inventory value 36 cents. On April 20th, we record the purchase of the 4 15-cent items, debit merchandise inventory and credit accounts payable for 60 cents. That entry will give us a new inventory layer. The new inventory valuation is 96 cents. On April 27th, a customer purchased 5 items for cash. Debit cash and credit sales for $5. We still debit CGS and credit merchandise inventory. To determine the amount, we once again fill out those 5 items starting with the oldest layer first. We'll apply all 3 remaining units from the 12-cent layer. To get to the 5 sold, we just need 2 units from the most recent purchase. As for the cost of inventory we have left, the 12-cent layer is gone. The 15-cent layer only has 2 units left. Consequently, ending inventory is valued at 30 cents. As we did at the end of the specific ID scenario, you can corroborate this amount by drawing a T account for merchandise inventory, posting the transactions, and calculating its balance. Turn to workbook pages 10 and 11. Let's repeat the same exercise, but under the LIFO method. As with the previous examples, the first couple of entries will be the same. Debit merchandise inventory and credit accounts payable for 40 cents. For April 3rd, record the sale at $2 and expense merchandise inventory at 20 cents. Remaining inventory is now 20 cents. Our April 6th entry will also be replicated. After adding that 48-cent purchase to our current inventory layer, we'll have total inventory of 68 cents. The sales portion of our April 12th entry will also be repeated. And we'll still debit CGS and credit merchandise inventory in the expense portion. Last in, first out means we fill out these 3 units sold with the most recent layer first and work our way backwards. Since the last layer has more than enough units to cover the 3 units sold, we only pull from this layer. After which, this more recent layer drops from 4 units to 1 unit, and inventory is valued at 32 cents. The purchase on April 20th will still debit merchandise inventory and credit accounts payable for 60 cents. Hopefully by now you've noticed that the purchase entries and the sales entries to recognize revenue aren't impacted by whichever cost flow assumption we use. Only the expense amount of the cost of sales changes. Add that purchase to our inventory layers, bringing total inventory to 92 cents. On April 27th, the customer purchase of 5 units will affect a debit to cash and a credit to sales, as well as a debit to CGS and a credit to merchandise inventory. To get the latter entry's amount, we once again pull 5 units out of merchandise inventory, starting with the most recent layer first and working backwards. We'll need to take 4 units at 15 cents and 1 unit at 12 cents. Afterwards, the most recent inventory layer from the April 20th purchase will be at 0, as will the middle layer. Consequently, ending inventory is presumed to only have 2 units from the month's earliest purchase, 20 cents. You can draw a T account for merchandise inventory to verify its accuracy. Once more with the same transactions, but let's apply the weighted average cost method. Turn to pages 12 and 13 of your workbook if you have it. The first 2 entries will be the same as under the LIFO, FIFO, and specific identification methods. On April 1st, debit merchandise inventory and credit accounts payable. Total merchandise inventory on hand is 40 cents. On April 3rd, the sale of the 2 10-cent items will be recorded with a debit to cash and a credit to sales of $2. Then debit CGS and credit merchandise inventory for 20 cents. We don't need to calculate the costs because all of our inventory was purchased at the same price. After this sale, we have 2 units left for a total inventory value of 20 cents. On April 6th, the purchase of 4 12-cent items will entail a debit to merchandise inventory and a credit to accounts payable for 48 cents. Add that purchase to our current inventory items and we have 68 cents worth of inventory. Remember the rule I gave in my lecture video for the weighted average cost method. Every time you make a purchase, calculate the average cost of inventory. We have our total cost of inventory, so all we need to do is divide it by the number of units on hand. Divide those numbers out, and the average cost is 11.3 cents per unit. On April 12th, the customer's purchase of 3 items will have the same revenue of $3. When we record the debit to CGS and the credit to merchandise inventory, multiply the number of units sold by the previously calculated weighted average cost. As for remaining inventory, we had a total of 6 units and we just sold 3, so remaining inventory will consist of 3 units at that weighted average cost. On April 20th, we buy 4 15-cent items on account. Debit merchandise inventory and credit accounts payable for 60 cents. Add this purchase to our current inventory layer and calculate the new weighted average cost. You should get approximately 13.4 cents per unit. On April 27th, we have cash sales of 5 units. Debit cash and credit sales for $5. As for the debit to CGS and credit to merchandise inventory, multiply the 5 units sold by 13.4 cents. How much inventory remains? We just sold 5 of our 7 units, so we have 2 units left at 13.4 cents per unit, or 27 cents worth of inventory. As in previous scenarios, you can verify this amount by drawing a T account for merchandise inventory. Next, let's look at some lower of cost or market problems on page 18. Starting with number 1, Bowie owns 100 DVD players that were purchased for $180 each. As a result of technological advances, Bowie's supplier has reduced the cost to purchase these DVD players to $125 apiece. Bowie can sell the DVD players at $275 each. At what value should these DVD players be recorded in the ledger? Lower of cost or market is just as the name suggests, a comparison between cost and market price, $180 and $275 respectively. Next, we determine the total cost and total market price of that inventory. Multiply our 100 units by 180 to get a total cost of $18,000. Do the same but with 275 to get a total market value of $27,500. Lower of cost or market says that we use the lower of these two numbers, $18,000 in this case, to value our inventory. Remember our cost principle. When Bowie purchased this inventory, it recorded the purchase at cost. So that's the amount sitting in the merchandise inventory T account. Consequently, we don't have to record any write-down. Just leave it as is. Number 2. Bowie owns 50 CD players that were purchased for $75 each. Bowie had been selling these units for $150 each. However, a new electronics store has just opened that sells the same CD player for $130 each. Even though Bowie's supplier is still charging $75 to purchase the units, the store has been forced to lower its retail price to $130, matching the competition. We can set this one up the exact same way as number 1. Bowie has 50 units at a cost of $75 per unit and a market price of $130 per unit. Multiply our totals to get a cost of $3,750 and a market price of $6,500. Bowie still uses the lower number of its cost. Even though the market price dropped from $150 to $130, it did not drop enough to necessitate a write-down from its cost. As in number 1 above, no write-down journal entry is required. Number 3. Bowie has 25 cassette players that were purchased at $80 each. Because of a severe decline in the market for cassette players, Bowie must drop the retail price of these units to $50 each. Bowie is also offering a free 4-year extended warranty on each cassette player sold. Bowie's cost for this warranty is $5. The store also pays sales clerks a 7% commission on all units sold. Repeat the same setup as in the previous problems. Bowie has 25 cassette players at a unit cost of $80 and a market price of $50. Before we multiply out our totals, we need to adjust that market price for some additional costs. The cassette players have a retail price of $50. However, when Bowie sells such an item, that's not the net amount of revenue it earns. Bowie has to pay $5 for a warranty and pay the salesperson a $3.50 commission, 7% times that $50 sales price. After those deductions, each cassette player has a net realizable value of $41.50. So that's the amount we use for the market price. Multiply out our total costs and total market price to get $2,000 and $1,037.50, respectively. Now, the market price is below the cost, so we need to book a journal entry to write it down. Merchandise inventory was initially recorded at cost, $2,000, and we need to reduce it to that market price. Consequently, debit cost of goods sold and credit merchandise inventory for $962.50. Let's turn to page 21 to go over the impact of inventory errors. Imagine that after preparing these financial statements, Johnson Company discovered that the physical count of ending inventory was understated by $4,000. Let's identify the impact of this error on cost of goods sold, gross profit, net income, current assets, total assets, and equity. What was that formula I told you to memorize? Beginning inventory plus purchases less ending inventory equals cost of goods sold. If ending inventory is understated by $4,000, cost of goods sold will be overstated by that amount. To better present the impact of these errors, let's show the corrected amounts adjacent to the incorrect amounts. Sales revenue won't be affected. What's the correct cost of goods sold amount? If $19,000 is overstated by the correct number of $4,000, then the correct number should be $15,000. Subtract $15,000 from $37,000 in sales, and gross profit should be $22,000. Here you see the impact of this inverse relationship. Overstating cost of goods sold by $4,000 understated gross profit by that amount. Like sales, operating expenses are also unchanged, but net income should turn out to be $13,000. Here we see that profit was also understated by $4,000. Net income is going to flow into the balance sheet via the statement of owner's equity. If net income is understated, then ending owner's capital will also be understated. This will go on to understate equity on the balance sheet. If $19,000 understates the correct amount by $4,000, then the correct amount is $23,000. Liabilities will remain at $41,000, but total liabilities and equity will be $64,000. Ending inventory is reported in the assets section of the balance sheet, specifically under current assets. That $22,000 amount understates the correct amount by $4,000. So the correct number should be $26,000. Fixed assets will still be $38,000, but total assets should be $64,000. We only have a couple of more examples. Turn to page 22 to go over the retail method of estimating the cost of ending inventory. I've replicated the table from the bottom of the page. Both this method and the gross profit method use our formula to derive ending inventory. Using the retail method, we proceed as follows. First, sum beginning inventory with purchases to get our goods available for sale. we subtract what we sold from our goods available for sale, what remains is our ending inventory. The problem with that $32,000 is that this number is the retail value, and we're looking for the value at cost. We can estimate that with the cost to sales ratio. Divide the $67,000 cost of goods available for sale by its corresponding $100,000 retail value of goods available for sale, and we get 67%. In other words, for every $1 of sales, we have 67 cents of cost. Multiply that ratio by the retail value of ending inventory, and the cost of ending inventory is $21,440. On the bottom of page 23, you'll find the following information. Let's determine the cost of ending inventory using the gross profit method. As you can see, this method is useful for when you don't have the retail values for beginning inventory or purchases. First, organize the information as we did under the retail method. If we had the cost of our sales, not just the sales at retail, we could calculate the cost of ending inventory. We can acquire our cost of sales by multiplying our sales at retail by the cost to retail ratio. Just as we did in the previous example. Unfortunately, we don't have the cost to retail ratio because we don't have the retail amounts for goods available for sale. However, we do have the gross profit ratio, which we can convert to the cost to sales ratio by subtracting it from 1. In this case, we have 60 cents of cost for every dollar of retail value. Multiply that percentage by $95,000, and our cost of goods sold is $57,000, making ending inventory $13,000. That concludes this section of the workbook problems. I know it was long, but this chapter covered a lot of material. There should still be a couple of textbook problems for you to work on regarding FIFO, LIFO, and the weighted average cost flow assumptions. I recommend trying those on your own. I hope this video was helpful. Let me know if you have any questions. I'll see you in the next one.